Looking for some wonderful businesses to invest in that can make you incredibly wealthy over time? Like the idea of collecting safe, growing dividend income that you could live off of for decades? Want to know my top 5 stocks for June 2023? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal 6-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. The US stock market is a wealth building machine, but it's also a machine that tests patience and rewards those who can pass. Warren Buffett put it like this: the stock market is a device for transferring money from the impatient to the patient. Passing this test requires you to deal with volatility along the way. Stock prices can drop dramatically over short periods of time, but this isn't necessarily a bad thing at all. See, price and yield are inversely correlated. All else equal, lower prices result in higher yields. That means more passive dividend income on the same invested dollar, which makes financial independence an easier and faster target to reach. I always see short-term volatility as a long-term opportunity. And that perspective helped me to go from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. All that said, it's a big market and some ideas are better than others. Focusing on the very best long-term ideas right now is what this video is all about. Today, I want to tell you my top 5 dividend growth stocks for June 2023. Ready? Let's dig in. My first dividend growth stock for June 2023 is Accenture PLC, stock ticker ACN. Accenture is a professional services company specializing in IT services and consulting. Accenture should be called Accelerate, as in accelerate your wealth, passive income, and financial freedom, assuming you're a shareholder. And why is that? Because Accenture is accelerating solutions for its clients. See, enterprises have all kinds of problems. Properly navigating the digital transformation could be one example. Formulating a strategy for entering new markets might be another example. Well, Accenture helps to solve enterprise problems just like these. The combination of enterprises, problems, and solutions are nearly endless. And that's exactly why Accenture has put up an 8.2% compound annual growth rate in revenue and 9% compound annual growth rate in earnings per share over the last decade. Solid, consistent business growth is exactly what's fueled solid, consistent dividend growth. Accenture has already increased its dividend for 18 consecutive years. I'm highly confident that it'll be a dividend aristocrat in about 7 years. The 10-year dividend growth rate is 10.5%. That's slightly outpaced earnings per share growth, but the low payout ratio of 38.8% still offers some flexibility here. The only drawback to the stock might be its yield, which is only 1.6%, but this is a very high quality compounder, not high yield junk. Accenture isn't super cheap, it never really is, but I think it's decently undervalued here, and that's enough in my opinion. If you want single-digit PE ratios and 10% yields, you can get that elsewhere in the market. Of course, those are also where poor total returns are usually found. This stock, on the other hand, has compounded at an annual rate of nearly 15% over the last decade. What a winner. We recently put together a full analysis and valuation video on Accenture, and that video showed why this world-class compounder is estimated to be worth right about $310 per share. The stock has already moved up since that video came out, but the pricing of $290 still offers some potential upside. Make sure you take a good look at this one. My second Dividend growth stock for June 2023 is BlackRock Inc., stock ticker BLK. BlackRock is a multinational investment management corporation. Well, that's not quite right. BlackRock is the world's largest investment management corporation. No competitor is bigger, and it could be argued that no competitor does it better. This is a field in which size truly does matter, as you're benefiting from the rising tide of capital markets, lifting all boats, except BlackRock is the biggest boat, and that disproportionately benefits the firm. That explains why BlackRock has compounded its revenue at an annual rate of 6.5% and its earnings per share at an annual rate of 8.1% over the last decade. BlackRock is a dividend rock. The asset manager has increased its dividend for 14 consecutive years with a 10-year dividend growth rate of 12.5%. And the stock yields an even 3% right now. That's a very nice combination of yield and dividend growth. You're beating the broader market on yield and you're outpacing inflation with the dividend growth. Hard to complain about that. The payout ratio of 62% is elevated, but that's mostly a function of temporarily depressed earnings on the back of a tough stretch for markets. It's also been a tough stretch for this stock, which has led to what I think is a pretty reasonable valuation. Shares were trading hands for nearly $1,000 each not long ago. They're now down to about $667 each. It might have gotten ahead of itself at the top, just like a lot of stocks did, but is it still ahead of itself? I don't think so. The 30% plus collapse in pricing has compressed the valuation down to a much more reasonable level. The price earnings ratio of 20.7 is a good example of that. Is that not sensible for a company of this stature, quality, and positioning? I'd argue it is. And I do argue that in a full analysis and valuation video on BlackRock, which should already be live by the time this video comes out. In that video, I calculate an estimate of fair value to be $825 per share for the business, decently above current pricing. If you haven't considered BlackRock before, now would be a good time to change that. My third dividend growth stock for June 2023 is Essex Property Trust Inc., stock ticker ESS. Essex Property Trust is a multifamily property real estate investment trust. REITs can be super hit and miss, just like anything else. Some REITs have definitely seen their better days, especially if their business model is catering to the real estate of yesteryear. Think poorly located, dreary shopping malls. Also, think Class C office buildings. But Essex Property Trust suffers from none of this. First, it caters to a basic need that people can't live without: shelter. We're talking about apartments here. Second, its portfolio of properties are high quality, newer assets in high quality, naturally desirable locations. That's why it continues to put up strong numbers for a REIT. Revenue has compounded at an annual rate of 11.3% over the last decade, while funds from operations per share compounded at an annual rate of 6.8% over that time frame. Want more evidence of strength? This is a rare dividend aristocrat. It's one of only 3 REITs that can claim that special status. Essex Property Trust has increased its dividend for 29 consecutive years. What's so impressive about this is that it dates all the way back to the REIT's original 1994 IPO. The 10-year dividend growth rate of 7.2% lines up very nicely with funds from operations per share growth over that same stretch. And you're pairing that solid dividend growth with the stock's market-smashing 4.4% yield. With the payout ratio sitting at 62.5%, Essex Property Trust is positioned to keep its dividend aristocrat status for many years to come. For years, this stock was so expensive, but not now. I avoided Essex Property Trust for years and years out of valuation concerns, but now, after a 40% collapse from its all-time high in price, which was reached not long ago, the valuation has become more attractive than I've ever seen it. Its 5-year average price to cash flow ratio is 20.6. Pricey. It's now 14.6, which is downright cheap. We put together a full analysis and valuation video on Essex Property Trust, which should be live by the time this video comes out, and you can see why the REIT could be worth almost $271 per share. The stock's pricing of about $210 obviously compares very favorably to that. This might be a short window of opportunity in which this high-quality dividend aristocrat is buyable. My fourth dividend growth stock for June 2023 is Qualcomm Inc., stock ticker QCOM. Qualcomm is a multinational technology corporation. In my view, Qualcomm has transformed itself from a strong company into an even stronger company. Qualcomm took a lucrative base of handset IP and parlayed that into a diversified tech behemoth with exposure to 5G, broadband, modern RF systems, gaming, IoT, self-driving autos, AI, and AR/VR. And that has fueled great top line and bottom line growth over a sustained period of time. Revenue has compounded at an annual rate of 6.6% over the last decade, while earnings per share compounded at an annual rate of 12.6% over that stretch. Double-digit business growth has fueled double-digit dividend growth. The 10-year dividend growth rate is 11.7%, and you can see how well that lines up with bottom line growth. Management has been on the ball here. This is a dividend that has been increased for 21 consecutive years, only a few years away from vaunted dividend aristocrat status. The stock yields 3%, which easily beats what the broader market gives you, and the low payout ratio of only 30.9% gives Qualcomm plenty of headroom on the dividend. I see many years of dividend raises ahead. This might be one of the very best long-term investment opportunities in all of tech right now. This stock was running close to $200 just over a year ago. It's now trading the $100 area. So the stock got cut nearly in half, yet I don't see anything in the business in terms of its long-term potential to warrant that. We recently analyzed and valued Qualcomm, and the video on that should be going live soon if it hasn't already. The valuation came out to $139.20 per share, so it looks about 20% undervalued right now. This is a great business, and unlike almost everything else in tech, the valuation is very undemanding. Take a look. My fifth dividend growth stock for June 2023 is Williams-Sonoma Inc., stock ticker WSM. Williams-Sonoma is a multi-channel retailer of high-quality home products and furnishings. The issues that plague many retailers out there do not plague Williams-Sonoma, and that's because the company saw the curve coming and prepared for change. A prime example of this is e-commerce, the bane of many B&M retailers. Williams-Sonoma made e-commerce a pillar of the company's selling strategy years ago. The e-commerce channel now makes up 2/3 of the company's sales. This forward-thinking retailer dazzles across the board, including growth, a 7.9% compound annual growth rate for revenue and 21.5% compound annual growth rate for earnings per share over the last decade. The dividend also dazzles. Williams-Sonoma has increased its dividend for 18 consecutive years, and this is not like some of those other retailers out there handing out tiny annual dividend increases in order to just keep a streak alive. No, the 10-year dividend growth rate for Williams-Sonoma is 13.2%, and you get to pair that double-digit dividend growth with the stock's starting yield of 3.2%. Not dazzled enough yet? Okay. The payout ratio is just 22.1%, even after all of those big dividend raises. Incredible stuff here. I think this high quality dividend growth stock is severely undervalued. I'm not sure why Williams-Sonoma doesn't get the love it ought to. Other than a brief time during the market's 2021 manic episode, this is a stock that consistently flies under the radar and commands low multiples. I mean, the price earnings ratio right now is below 7. We just combed through this business, and the video going over that should be live by the time this video comes out. The valuation estimate on the business worked out to just over $165 per share. The stock is currently priced at about $112. We're talking about the potential for more than 30% undervaluation. Want a terrific business at a low valuation? Williams-Sonoma could perfectly fit the bill. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did. And let us know in the comments what you think about these top 5 dividend growth stocks for June 2023. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and am often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.